Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Church Dwight Co. Inc. Annual Report. Church Dwight Co. Inc. offers a diverse range of household, personal care, and specialty products under various brands. The company's consumer products include baking soda-based items such as Arm & Hammer cat litters and laundry detergents, OXICLEN stain removers and cleaning solutions, Batiste dry shampoos, WATRPIK water flossers, THERABRETH oral care products, Hero acne treatment products, TOUCHLAND hand sanitizers, and Trojan condoms and lubricants. In addition to these consumer products, Church & Dwight also offers a variety of specialty products. These include animal and food productivity products such as Arm & Hammer baking soda, used as a feed additive for dairy cows, BioCHLOR and FERMENTEN, used to reduce health issues associated with calving, CLMANAX refined functional carbohydrate, and CERTILLUS probiotics products. The company's product portfolio also includes oral analgesics under the ORAJEL brand, home pregnancy and ovulation test kits under the First Response brand, laundry detergents under the XTRA brand, cold shortening and relief products under the ZICAM brand, sodium bicarbonate, and cleaning and deodorizing products. Church & Dwight sells its consumer products through various channels including supermarkets, mass merchandisers, wholesale clubs, drugstores, convenience stores, home stores, dollar and other discount stores, pet and specialty stores, websites, and e-commerce channels. The Church & Dwight Co. Inc. (CHD) stock price has remained relatively stable in the past year, with no significant changes beyond a -3.82% threshold. Despite several key news events, including earnings reports and analyst rating updates, the company's stock price has not experienced any substantial fluctuations. One of the most notable events was the Q4 2024 earnings report, which initially led to a 1.5% decline in shares due to disappointing first quarter 2025 guidance. However, this movement fell within the specified threshold and did not have a lasting impact on the stock price. The company's Q4 and full year 2025 results, announced in January 2026, were stronger than expected, with net sales increasing 1.6% and adjusted EPS beating analyst estimates. The announcement also included a confident outlook for 2026, which was met with a positive reaction from investors. Despite this, the stock price remained essentially flat, down just 0.07%. The company's portfolio reshaping and acquisitions, including the divestment of non-core businesses and the acquisition of Touchland Holding Corp., were also integrated into the overall performance and outlook without any significant single-event impact on the stock price. Overall, while several key news events occurred in the past year, they did not have a substantial impact on the Church & Dwight Co. Inc. (CHD) stock price, which has remained relatively stable within the specified threshold. Church & Dwight Co. Inc. market capitalization of $24 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Church & Dwight Co. Inc. holds a significant advantage in their industry. Church & Dwight Co. Inc. trades at a higher price-to-earnings ratio of 33 times and a higher price-to-book ratio of 5.96 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and can be attributed to various factors. On one hand, acquisitions have been a significant driver of revenue growth, with notable examples including the Touchland acquisition and Graphico acquisition. These strategic moves have contributed to substantial revenue increases. On the other hand, several factors have led to revenue decline. The exit from the Spinbrush business has resulted in lost sales, while the VMS business deterioration due to product competition and lower estimates of future growth has also had a negative impact on revenue. Furthermore, customer distribution losses, decline in consumer demand, lower consumer spending, and increased competition from value brands amid inflation have all contributed to revenue decline. Additionally, other factors such as changes in future demand for products, technological changes, new product introductions, unit volume growth rates, and revenue and expense growth rates may also impact revenue growth or decline. These factors highlight the complexity of revenue dynamics and the need for businesses to adapt to changing market conditions to maintain growth. Net income experienced a significant increase of $270.5 million, or 33.5%, from $807.1 million in 2024 to $1,077.6 million in 2025. However, this growth was short-lived, as net income decreased by $15.3 million in the subsequent period. A closer look at the data reveals that net income had previously declined by $111.5 million from $967.4 million in 2023 to $756.3 million in 2024. The profit margins also underwent changes, with operating margin increasing by 410 basis points to 17.4% in 2025. Conversely, gross margin decreased by 100 basis points to 44.7% in the same year. The effective income tax rate rose by 40 basis points to 23% in 2025. The reasons behind these changes are multifaceted. Higher manufacturing costs and tariffs were offset by productivity programs and benefits from acquisitions, while non-cash charges associated with exiting businesses and acquisition-related expenses had a negative impact on net income. Additionally, favorable tariff rulings and tariff refunds in the prior year contributed to the fluctuations in net income. The company's financial performance indicates a consistent trend of generating positive operating cash flow over the past 3 years. According to the provided data, in 2025, the company generated $1,215.4 million in cash from operations, surpassing the previous year's figure of $1,156.2 million and significantly exceeding the $1,030.6 million recorded in 2023. This upward trend suggests that the company is effectively managing its operating activities, resulting in a substantial increase in cash flow. The confirmation of positive operating cash flow on multiple pages further reinforces this conclusion, providing assurance that the company's financial health is stable and improving. The company's debt level has remained relatively stable over the past 2 years, with no significant change between 2024 and 2025. The total debt at December 31, 2025 was $2,205.1 million, which is only a slight increase from the previous year. In contrast, interest expenses have shown some fluctuations, but overall remained relatively stable with a slight increase of $0.2 million, 0.2% increase, from 2024 to 2025. This suggests that while the company's debt level has not changed significantly, its interest expenses have been manageable and have not posed a major concern for the company's financial health. The performance of various segments and regions in the market has been mixed. On a positive note, the consumer international segment in Europe and Canada have shown significant growth, with increases of 24% and 23%, respectively. The consumer domestic segment has also seen an increase in revenue and income from operations, rising by $1.2 billion to $1.4 billion and $234 million to $278 million over the next 3 years. However, some regions have struggled due to various challenges. China faces strong competition from local manufacturers, while Ukraine is affected by sanctions introduced in response to conflict. Countries with increased tariffs or trade restrictions, as well as those plagued by political or economic instability, civil unrest, wars, and military conflicts, are also performing poorly. In addition, Mexico and Australia have seen lower growth rates compared to Europe and Canada. Furthermore, certain product categories have been impacted by increased competition. The diagnostic kits and oral analgesics categories have experienced a shift towards private label products, leading to decreased sales. Overall, While some regions and segments have shown promise, others continue to face significant challenges that must be addressed in order to achieve long-term success. Management is optimistic about the company's outlook, citing a strong portfolio of power brands with significant global expansion potential. The company has made strategic acquisitions to expand its portfolio and has adequate reserves to support sodium bicarbonate requirements. However, management notes that sales are being impacted by shifting consumer behavior towards online shopping and changing market dynamics. To adapt to these changes, the company plans to invest in facilities and operations, upgrade technologies, and develop new and differentiated products. Management also emphasizes the importance of its sustainability strategy, which has a positive impact on the environment and communities. The company aims to expand its presence globally, pursue strategic acquisitions, and focus on core growth. Despite these efforts, management acknowledges several risks and challenges, including assimilation of acquired companies, commodity cost volatility, economic uncertainty, and cybersecurity threats. To mitigate these risks, the company has entered into hedge agreements to manage diesel fuel price volatility, foreign currency exchange rate fluctuations, and commodity price fluctuations. Management also notes that market category declines and changes in product mix may impact sales growth targets, and high competition in mature markets makes it challenging to differentiate products and maintain profit margins. However, the company is confident in its ability to adapt and overcome these challenges, with a strong financial position and sufficient cash and borrowing capacity to fund share repurchases, pay debt and interest, pay dividends, and meet capital expenditure costs. The company has made significant acquisitions over the years, expanding its product portfolio and market presence. Notable acquisitions include Varied Industries Corporation in 2015, Spencer Forest, Inc. in 2016, and ANUSOL and RECTNOL businesses from Johnson & Johnson in 2016. In 2020, the company acquired ZICAM brand from Consumer Health Holdco LLC, followed by THERABREATH brand from Dr. Harold Katz, LLC and HKAP International, Inc. in 2021. The company also made strategic acquisitions in 2022 with the Hero brand, including Mighty Patch Acne Treatment Products and Graphico, Inc. in 2024. Additionally, TOUCHLAND hand sanitizers were acquired in 2025. These acquisitions have been financed through various means, including term loan facilities and senior notes. On the other hand, the company has also made divestitures to streamline its operations and focus on core businesses. The Vitamins, Minerals and Supplements (VMS) business, including VITFUSION and LIL Critters trade names, was sold in 2025. The Flawless, Spinbrush, and Waterpik showerhead businesses were also exited by the end of 2025. Furthermore, the company divested its 50% interest in Arma Clean to a joint venture partner in October 2024. These divestitures demonstrate the company's commitment to strategic decision-making and optimizing its portfolio for long-term growth. The company's financial activities have been focused on both rewarding its shareholders and reducing the number of outstanding shares. One way it has done this is by paying out cash dividends to its investors, totaling $287.2 million. This demonstrates a commitment to returning value to its shareholders through regular distributions. In addition to dividend payments, the company has also engaged in share repurchases, buying back $900 million worth of its own shares. This strategic move aims to increase earnings per share and boost investor confidence by reducing the number of outstanding shares on the market. Concerns about inventory buildup and supply chain disruption are evident in several pages of the extracted summaries. On page 3, a significant inventory valuation charge was incurred due to impairments of intangible and fixed assets, exit of certain businesses, and inventory issues. Additionally, volatility in commodity markets, page 15, and reductions in inventory by customers, page 16, pose challenges. Furthermore, pages 18 and 27 highlight various supply chain disruptions, including delays or cost overruns in expansion projects, material shortages, logistics disruptions, and supplier capacity constraints. The impact of these disruptions is exacerbated by the dependence on sole source suppliers for certain products/raw materials, and the potential for labor shortages, natural disasters, pandemics, and transportation disruptions. However, it's worth noting that not all pages mention concerns about inventory buildup or supply chain disruption. In fact, several pages, pages 1, 4, 6, 7, 9, 19, 22, 28, 39, 40, 44, 48, 51, 57, 64, 65, 67, 84, 87, 95, and 101 do not mention any specific concerns in this regard. That concludes the financial summary for Church and Dwight Co. Inc. Feel free to comment below, and I will be happy to answer them when possible.